Hello and welcome to the Short View. I'm John Authors. Well, we have more drama today in the oil market. The price of crude has almost reached $114 per barrel, and that's largely a reaction to the very scary news we got overnight with Russian oil producers predicting that Russian oil production may have peaked and be ready to decline. I'd just like to make a couple of points to put that in some perspective. First of all, let's take a look at this. This shows you world oil supply since 2002, when the oil bull market really got going, compared to the oil price. And you can see that global supply really did increase quite fast from 2002 through to 2005. So at that point, this was plainly a demand-driven phenomenon. But that since 2005, there's really been quite an ominous plateau. Despite the obvious increase in demand for oil, producers haven't increased supply, and that's obviously worrying. It suggests there may be some permanent constriction on supply. However, if we take a look at the stock market, there are some reasons for optimism. Let's first of all show you the S&P 500 energy index compared to oil prices, and you can see that oil stocks have significantly underperformed since the beginning of last year, and that's a signal that the stock market doesn't think these oil prices are sustainable at this level. Now let's show you Lukoil, which made that bearish prediction, and you can see that their stock price has barely gone anywhere since the beginning of last year. But now let's take a look at Petrobras, which is the big Brazilian oil producer. And there's been a big new find of oil in Brazil, which will come on stream in the next few years. And you can see, although that's still a long way in the future, that the market regards that as very great reason for optimism about Petrobras. So maybe today's reaction to the scary news from Russia may have been somewhat of an overreaction. The dollar is at a new all-time low against the euro, and it's easy to see why. It's because of inflation. Take a look at this. We had inflation numbers on both sides of the Atlantic today, and as you can see, headline inflation in the eurozone is at its highest level in many years, although still behind the US. Now, obviously, with increasing fuel and food prices, that's not particularly surprising, but if we now show you core inflation, stripping those out, we get exactly the same picture. Inflation is higher in the US, but rising to its highest level in many years in the eurozone as well. Now, with those bad inflation numbers out there, that reduces any chance at all that the ECB will be cutting rates, and here we're showing you the overnight rates in the US and the eurozone since the beginning of this decade. And of course the Fed is extremely committed to cutting rates to deal with the credit crisis, and the result is that at the moment European rates exceed US rates by more than they have ever done since the introduction of the euro. Basic economics tells you that if inflation is higher in the US, but that also that interest rates are lower, you would expect that to weaken the currency, and despite all the other factors on the dollar, it's going to be very difficult for the dollar to strengthen while that remains the case. There are other factors pushing on the dollar, however, particularly the housing market. Take a look at this. We had housing starts and permits data today, and you can see from this that the collapse in activity in the housing market is really quite dramatic. We've fallen almost 60% since the top back in 2005, and that's obviously not going to help the dollar. And now if we show you what's happened to the stocks in home builders over that period, you can see that they used to map the starts and permits data quite closely, but in the last few months they've gone on a rally even while the housing market has continued to deteriorate. That looks a little hopeful. Commodities are up again today, and oil is at a new record, and it's really quite remarkable. I'd like to demonstrate that for you with a chart that was first shown to me by Jim Paulson at Wells Capital. Take a look at this. What we're showing you here is Treasury 10-year bond yields over a long period of time, and comparing those to real commodity prices. That's non-energy S&P commodity index, taking away the level of US consumer price inflation. And you can see that they've moved very closely together over the years, and that's not surprising because they're both related to inflation and the level of activity in the economy. When there's a lot of activity in the economy and people are worried about inflation, bond yields will be high, and so will commodity prices. When we're in recessions, you would expect both of them to be low. So how can we explain the total and sudden disjunction we've seen in the last few months, with commodity prices going through the roof while bond yields go down as people fly to quality? Well, the most likely scenario is that this is a temporary phenomenon, and that those two lines will come back together. That will involve somebody losing money. Either people will realise that the flight to quality has been overdone, and then people will take losses on their bonds as they move back into riskier assets, or, as many people will fear, commodities will prove to have been a bubble and commodity prices will come down sharply. And perhaps the most likely scenario is that there will be elements of both of those. Now, neither of those scenarios is particularly comforting, but they are both perhaps more pleasant to believe than an explanation that would actually justify this disjunction. And that explanation is that we are seeing real, true supply constraints appearing in a range of commodities. The world is actually knocking up at its ultimate capacity, and prices are having to rise to help ration various commodities. So let's hope that that scenario isn't true, and that those two lines come together sometime soon.